Even pirates know the best way to make money isn't to bury it, but invest in the stock market. As early as 1783, in a piracy haven called Nassau in the Bahamas, the real pirates of the Caribbean were trading stolen booty in a stock market. Now that might not be how you expect a stock market for beginners video to start, but I am going to walk you through step by step through everything you need to understand the stock market and how to invest. But I've got to warn you, while I can say without exaggeration that the market is truly a magical place that can make money appear seemingly out of nowhere, there's also some crazy stuff going on as well. So not only am I going to show you everything you need to know about stocks, we'll also look at the weirder side of the stock market and 8 crazy facts you won't believe. Things like the top secret information that spies get from watching stocks, the Millionaire Housekeeper, and the 15-year-old that made $285 million illegally in stocks. I'll also reveal how the stock market in 2023 will be different from anything we've ever seen, how the economy has changed what we think about stocks. I know it's a long video, but stick with it because it's the only one you'll ever need to watch to understand the stock market and how to make your money work for you. And to prove I was not kidding when I said the stock market can make money appear like magic, this chart shows the profit on different amounts invested and different returns, and it's really amazing to think about. Investing just $50 a month at a return of 15% a year, easily achievable on some of the stocks we'll talk about, and you'll have made a profit of almost $250,000 on what you invest. That is $250,000. Instead though, invest $500 a month at that same return, the average for most investors, and you'll have almost $2.5 million. And the best thing about the stock market is anyone can start investing, and on less than what you might think. Walt Disney referred to his housekeeper, Thelma Howard, as the real-life Mary Poppins. Howard moved to California when she was just 17 and started taking up cleaning jobs. She worked for Disney for over 30 years to 1981, and to show his gratitude, Walt would gift the housekeeper 1 share of Disney stock every Christmas. You can see where this is going. By the time she died in 1994, the Millionaire Housekeeper had amassed a fortune worth $9.5 million. In her will, she split the money amongst her family and created the Thelma Pearl Howard Foundation to provide an education in the arts to underprivileged children. We're getting right into our stock market guide, but if you're new to the Bowtie Nation, a little about me. After serving in the Marine Corps, I started in real estate analysis and went on to over 10 years as a professional market analyst for venture capital and private wealth management. I hold a master's degree in business and the Chartered Financial Analyst designation, a 3-year professional track for stock market analysts. But we are not here for me, we're here for you. So what are your questions about the stock market and investing for beginners? I'm always updating this video, so let me know in the comments below what you want to know. On to our guide though, and it always amazes me how many investors really don't know what is a stock. It may sound fantastic, but a stock is actually a part ownership of a company. And companies need money to grow, and they have 2 choices here, to either borrow money through a bond issue or sell part of the company to investors. For example, there are just over 15.9 billion shares of Apple, and each one represents an equal ownership share in the company's profit and that cash payout. Of course, each share is only a tiny fraction of an ownership of the whole company. You would have to own almost $24 billion of those shares just to have 1% of the company, but the fact remains, every single Apple shareholder has a right to those future profits as long as they hold the stock. And like I said, each share of stock gets an equal claim to any future earnings and dividend payments, and that's where a stock gets its value. First, from the value of those dividends. Apple doesn't pay much of a dividend, only about 92 cents a share paid out in 4 installments right now, but it also made $6.11 in profits per share last year. Because like most companies, Apple doesn't pay out all of its earnings as profits to the owners, those stockholders, but it has an unwritten agreement. Stockholders allow management to keep most of those earnings back, reinvest them into the company to grow those future earnings. That's where the stocks get the other part of their value, from the future value of all those earnings that the company is going to be producing. The stock market, then, is just what it sounds like, a market for buying and selling stocks. In fact, the first of these was created out of necessity back in Amsterdam. The Dutch East India Company, the first company to issue shares to investors, was only contracted to redeem its shares for cash at certain periods. Instead of waiting though, investors started going to the public courtyard every day to see if they could sell some of their shares or even buy more. Throughout the centuries though, stock markets have developed to handle thousands of company stocks, and much of it is now traded through electronic trading. And as I hinted in the beginning of the video, stock markets come in all shapes and sizes. It wasn't just the bad old days of piracy that saw black market stock bourses. In fact, the first official pirate stock exchange was actually established in 2009, about 250 miles from Mogadishu, Somalia. Open 24 hours a day, the exchange allows these investors to trade their ransoms and their bounty collected by attacks on commercial ships. Now, we've already seen that you can make millions of dollars in stocks, but how does that work? How investors actually make money is either by holding their stocks and collecting those dividends, or by selling the stocks for hopefully a higher price than what they paid. Now, that difference between the selling price and the purchase is their return, and it's been very good, averaging over 8.5% a year over the last 3 decades. Now, some years are better than others, and we'll talk about why that happens later, but overall, a very good return on your money. But as we saw in that chart, it is not a guaranteed return. If the company doesn't make any dividend payments or look like it might have profits in the future, a stock's price can go to zero. There is no value in owning a company without future profits. And in fact, sometimes the outlook for profits on the entire market of stocks can be so bad that investors rush to sell and the entire market price falls, for a little while anyway. And that brings us to one of the most popular investing terms you're going to hear about stocks, a bull and a bear market. And no other term in stocks is as well known as the bull or the bear markets, but how this started is one of those crazy facts nearly everyone has forgotten. It apparently came from Spanish-ruled California back around the 19th century, where the bullfighting of the mother country met the savage animals of the New World. It was here that the caballeros would pit American grizzlies against bulls in a fight to the death. Legend goes, the Spaniards noted that bears swiped downwards while the bulls hooked upwards. Hence, an upward trending market would be a bull, while the downward crash was synonymous with the bear. Technically, though, a bull market is when the price of a stock, or the stock market itself, rises 20% from recent lows. A bear market, then, is when the stock or the stock market has fallen 20% from its peak. And here we see the history of bull and bear markets for the US stocks. The blue areas are those bull markets, and you can see have averaged just under 3 years with an average return of 111% during each period. That is double your money, but you don't get the bull without the bear. Now, the good news is that the bear markets have lasted on average only about 9.5 months, with an average loss of 35% from the bull market peak. Invest long enough and you're going to see that bear market. When stocks do fall, though, I just need you to remember 2 things. One is obvious from the chart is that bear markets do end and are actually very short, less than 10 months on average. I know, when stocks are falling, it can seem like they'll never come back up, but they do, and usually pretty quickly. The other fact to remember, though, obvious in any stock chart you look at, is that stock prices will recover and head higher. Even after the massive sell-off in 2008, where stocks lost half their value, stocks were back up to their prior highs within a few years. Anyone investing this year can tell you, with stocks crashing from the January high of 4,800 on the S&P 500 index, we are definitely in a bear market that will probably last into 2023. For beginners like yourself, though, 2023 could be a very good year. Stocks normally bounce out of that bear into the next bull market with some of the best returns you'll ever see. Data here from Dow Jones shows stock returns at different periods after the end of the bear market back to 1957. In the year after the low, that far right column here, stocks jumped on average 24%, and some years posted returns of 30 and even 50%. So we know that bear markets usually don't last more than a year, and the economy is still fairly healthy. That could make 2023 the perfect time to start investing. I'll show you 3 types of investing along with examples next, but you know I've got to send that special shout out to all you out there in the Bowtie Nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. These next 3 types of investing are arguably the biggest misconceptions investors have about stocks and are going to cost you thousands of dollars a year. I'm talking about the difference between day trading, swing trading, and long-term investing. And while most investors say they're in it for the long term, the truth is going to surprise you. Now, day trading is just how it sounds, buying and selling stocks each day. Here, you're trying to get just a fraction of a percent profit each day, selling everything out at the end of the trading day and starting over the next day. The idea here is that even a fraction of a percent profit compounded each day will make you rich. Just a 0.1% profit each day of 250 trading days a year is going to make you a 28% return, almost 3 times the stock market average. You can see here, even starting with just $100 and averaging a 0.5% return daily nets you over $53,000 in 5 years. The problem is investors do the math in their head and they get dollar signs in their eyes. They think it's as easy as just picking a few stocks each day, jumping in and out quickly, and making those millions of dollars. Unfortunately, that's about how much it costs them. Nation, I've said this on the channel before. Every single one of the successful day traders I know have been professional traders, devoting at least 6 to 10 hours a day doing it. That's 4 to 6 hours in front of their computer charting stocks and following patterns every day. It's another 2 or 3 hours a day researching their trends and then developing their strategies with it. The next investing strategy is called swing trading, and while most investors say they're long-term investors, this is actually what they're doing. Swing trading is buying a stock and holding it for less than a year. Here, you're investing because you think a stock is undervalued or because of an expected event coming up might break the share price higher. And again, while most investors say they're holding stocks for those long-term gains, data from the New York Stock Exchange shows differently. This shows the average number of years investors hold onto a stock, and we can see that up until the 70s, investors were buying stock and holding them for years, that long-term investing idea, up to 8 years on average in the 60s. But look at what's happened over the past 40 years. I guess investors have just got to be up their ass and can't sit still on a stock. The average time investors hold a stock today is just 5.5 months. That's less than half a year. Now I'll show you the difference between swing trading and long-term investing next, but basically investors just aren't getting the benefit from that long, steady growth in stock values. They're really only betting on those quick pops in a stock price. But swing trading is a legitimate investing strategy, especially if you're ready to put in the research and the time it takes to find those undervalued stocks or some of these other events. And some examples of swing trading strategies include stock splits. And while a stock split doesn't technically change the value of the company, it does lower the share price so much that more investors can buy, and that tends to produce a positive return within a month after the split. Another swing strategy is buying shares of a company before it spins off part of its business into new shares. I covered this in our Monday market update a few weeks ago, and research does show that buying these stocks to get the new shares of the new spin-off company does produce an average return of 13% above the stock market in the first year. Other swing trading strategies follow valuations, like the price to earnings ratio and technical strategies that I'll show you later, but these two will get you started. Long-term investing then is just holding your stocks for years. This is where you profit from that idea that good companies grow their earnings and that increases the stock price as an ownership of those earnings. This is the easiest way to invest because you're not constantly trying to find those new stocks and the ideas. You're just investing in a handful of companies and holding on to those for years. I'll also show you some examples of those long-term investing strategies next, but for 99% of the investors out there, this kind of long-term buy and hold, that's where you want to be. Just ask the man on the right here. You might recognize the two on the left, Apple co-founders Steve Jobs and Steve Wozniak, but there was a third co-founder, Ronald Wayne. 2 weeks after getting the company started in 1976, Ronald cashed out and sold his shares for just $800. Had he just held on to that long-term investing perspective, held on to his shares, Ronald's 10% stake in the company would be worth as much as $95 billion today. Hell, just his founding documents alone sold at an auction in the 90s for $1.6 million, making Ron the world's richest man that never was. I'll go into more detail and show you how to find those best stocks in the video next week on how to analyze those stocks, but the easiest long-term strategy is just dollar cost averaging. This is where you pick a handful of stocks, maybe 10 or 15 companies you really like, and then just invest an equal amount in each of those every month. This means you're going to slowly build up an investment in each stock over months and years and benefit from that long-term price appreciation. One of my favorite long-term strategies, though, is called theme investing. This is where you're looking for those big picture ideas that are changing our lives over the next decade or more. Trends like artificial intelligence, healthcare spending, and electric vehicles. From there, you look for the companies that are leading in each of those themes and invest in those. Because the idea here is that growth in that theme, that big picture idea, is going to take every stock involved higher. So you don't have to really even worry about picking the best stocks out there. With a little more research, though, picking that best stock benefiting from the theme, you're going to get double-digit returns every single year. But no matter what your strategy, a fact of life for investors is that stocks do crash. So I want to detail why the market crashes, when, and how to keep your sanity when it does. Now, at its most basic, stocks crash because there are people involved, and people get crazy when it comes to money. For proof, you only need to go back to Holland in the 1600s for the first market crash. Yep, besides the first stock exchange, the Dutch also gave us the first stock market crash. You see, back in 1634, tulips, yes, tulips, the flowers, were the next big thing. Newly independent from Spain, the Dutch economy was booming thanks to international trade through that Dutch East India Company, which was also the world's first issued stock. Bringing spices and other goods from Asia to sell across Europe, the Dutch were enjoying a period of unmatched wealth. And just like a boom in wealth can ignite a market frenzy in art, stocks, any other collectibles really, rare tulips became something people started trading for their beauty and scarcity. And because of a limited supply and growing demand, tulip prices spiked from December 1636 to February of 1637, with some jumping 12-fold in price. The most expensive tulip sold for over 5,000 guilders, as much as a new house cost. A satirical painting of the period ties tulip mania eerily to the stock apes of today, showing investors behaving like monkeys at a tulip auction. But then, just as prices seemed like they were going to make everyone rich, a flare-up of the bubonic plague scared buyers at one auction, and it started the entire house of cards to crash. When prices fell more than 20% in a week, investors panicked and sold for whatever they could get, crashing the market even further. In just 3 months, prices were right back to where they started just 6 months prior. Now, investors will make up all kinds of reasons and really excuses of why stocks fall, but at the very core of it, the truth is that stocks are that ownership of a company's earnings. When you own a stock, you own that share of the company's future profits. Well, those profits are going to fall in a recession. This chart by Deloitte shows the change in corporate profits back to 1948, with the recession shaded, and the effect is obvious. That drop in the economy means about a 10% drop in earnings. So the next time someone tries to make up some smart-sounding reason why stocks are in a bear market, just say, nah, it's the economy, stupid. So as the economy starts to slow down, as investors get spooked that we might be heading into a recession, they sell stocks, and that's why the stock market usually falls before a recession. Now, what is important though, and this is important, when stocks do start to crash like they did this year, is that you keep on investing. Nation, it always surprises me that investors get so excited when stocks are heading higher. They push everything they have into the stock market and even borrow money based on some hot tip from their Uber driver. But when stock prices start falling, they panic. They sell out of their stocks, sometimes taking a loss, and just stop investing altogether. When in fact, they should be doing the exact opposite. Ladies and gents, when stock prices are falling, that's when you know you're getting a good deal. As the bull market takes prices higher, you never quite know when that's going to be the top or when you're going to be paying too much for stocks. When the market falls, though, you know eventually those stock prices are going to rebound, and you know you're getting those investments at a discount. But now, while it's true that stock prices have always recovered from those bear markets, any given year seems kind of like a crapshoot, doesn't it? In fact, a lot of people wonder if investing is just another form of gambling. Of course, it's not a 50-50 shot that stocks are going to fall in any given year, but it does happen. Even with the risks, though, investing isn't just gambling. When you throw your dice at the craps table, you have no control over that outcome, and in fact, here, the way the payout is planned, the casino has the advantage. That bet is also a one-shot opportunity. You throw the dice and you either win or lose. You can throw the dice all you want, but it's going to be always the same lousy odds. With investing, though, you're able to put the odds in your favor by using research to find good companies to buy. Your investment isn't a bet that the company is going to make money this quarter or next, but that it's going to make money for years to come. You can control the outcome through the kind of research and analysis that we do here on the channel. Now let's look at a few ways that stocks are categorized to give you an idea of what to look for when you're picking stocks to buy. And one of the most common ways to categorize stocks is by sector. These are groups of companies that serve a common purpose, like utilities, consumer staples, and energy. There are 11 sectors of the economy, and within each of these, industries that produce a common product. For example, within the technology sector, you've got semiconductors, computer software and hardware, and storage. Within the healthcare sector, you've got pharmaceuticals, biotech companies, and medical services. Looking at stocks like this is important for a couple of reasons. At first, believe it or not, the majority of returns for any stock is really going to come from how the overall sector is reacting to the economy. For example, shares of financial companies generally do well when interest rates are rising and the economy is growing. Material stocks do well against inflation and when commodity prices are increasing. So investing in these big picture ideas like which sector is going to do well is another way to make your investing easier for you. Now, understanding the sectors is also important though because it's going to lower the risk in your investments. Owning stocks from at least 4 or 5 of these different sectors is going to smooth out the risks in any given sector in your portfolio. If the price of oil collapses and your energy stocks fall, you've still got those stocks in maybe consumer staples and healthcare to hold up your portfolio. If a recession hits those stocks in consumer discretionary, and people are still paying their utility bills and buying food, so your stocks in utilities and those staples are going to perform well. So remember, the stock market, or really the economy, is categorized into those sectors or groups of companies that serve a common purpose. The 11 stock sectors are broad categories like those real estate, technology, and energy. And then within each of those sectors, you have the industries that produce a common product. So software, food processing, biotechs. Two other ways stocks are categorized is by either growth or value. Investing in growth companies focuses on finding those stocks with faster revenue and earnings growth. Remember that a stock's price is largely determined by the future earnings flow, how high the market thinks the company can grow those profits. So these stocks with that earnings growth of 30 and 50% a year can see the stock price boom higher. A great example of this is cybersecurity company Zscaler, which I recommended back in September of 2019. Shares were up as much as 700% to the peak, and even after the crash are still up almost 200% on the revenue and earnings growth that have more than doubled over the time. So the upside to growth stocks can be amazing. These are the innovative companies changing the world in which we live, and any one could be the next Tesla or Apple. But as we say here in the nation, it ain't all rainbows and unicorns. There are downsides to this kind of growth investing. First is you can just be wrong about a company. It might not be that growth stock that you thought it was. Maybe earnings growth slows or the share price goes nowhere. The other downside, and this can be even worse because it is so frustrating, is stock prices for growth stocks are just as much a function of investor sentiment and the market. You can invest in the leader of an industry, a true growth stock, but the stock can still fall if the market just hasn't caught on to that growth. Now, for the true long-term investors out there, someone planning to hold their stocks for decades, it's not so much a problem. Growth companies grow. It's in the name. So earnings are going to keep growing and eventually justify that higher stock price, and the returns will be good. Looking for growth stocks, you're going to be focusing on a few core things. Most important is going to be not just that past growth. Has the company been able to grow its sales and earnings over the past few years, but that expected future growth as well? Do analysts expect that double-digit growth to continue? These are also usually smaller companies with a lot of room to grow. You're looking for the newer companies with an innovation or breakthrough that's changing how the business is done in that industry. The other side of this, kind of the opposite perspective and strategies, is value investing. In value investing, you still want to invest in companies that are growing their earnings because that's what drives the stock price, right? But you're also going to be focusing on how much investors are paying for those earnings. You're looking for cheap stocks. So here you're looking at valuation measures like the price to earnings ratio, which I'll show you how to use later in this video. You're looking for companies where investors are paying less, a lower price for each dollar in earnings. And pros of value investing are that it has historically beaten growth investing on returns. Here you see the portfolio value of a group of value stocks in blue and growth stocks in brown. And the difference has been widening for decades. Value stocks have beaten growth stocks. Now, except for recently. Here you see the growth stocks in blue and the value in red. But over the last 20 years, you can see since about 2014, in fact, growth stocks have outperformed with higher returns. I know that can be confusing, and it's not to say that value stocks won't once again start beating growth, only that the rule doesn't always play out. Now, another advantage of value stocks, though, is they just don't tend to fall as much as growth stocks in a stock market crash. The shares are already cheap, right? So they just don't have as far to fall. Again, looking for value stocks, you're going to be focusing mostly on those valuation measures that I'll show you later. You're looking for the stocks with a low price to earnings ratio or a low price to sales ratio. You still want to invest in companies that are growing those earnings, but your primary concern is getting the best deal possible. But again, which type of stock is best may depend on when you're asking the question. You see here that the two strategies have swapped leadership several times in the past 40 years. The blue portions of the graph here are those periods when value stocks produced higher returns, while the orange is when those returns on growth stocks dominated. For much of the period from 1983 all the way to 2008, value stocks produced a higher return. In fact, 17 of the 25 years were dominated by value stocks. But since 2008, it has been growth stocks that have led the way with a return of 2.7% higher each year. Now, that years-long outperformance of growth over value stocks may be turning in 2023. The advantage of growth stocks was in those historically low interest rates, which were lowered to zero after the 2008 crash. At a near 0% interest rate, the future cash flows of growth stocks are worth much more, and investors rushed in to buy the stocks. But that's changing for 2023, and the Fed has already increased rates by nearly 4%. With interest rates set to approach a longer-term 5% level, value stocks could retake that long-term outperformance over growth. And we've seen those different types of stocks, but just as important is that how to invest. And for that, one of the best ways to invest in stocks is through an exchange-traded fund. Now, exchange-traded fund, or ETFs, are portfolios of stocks, bonds, or other investments grouped and then managed by portfolio managers to give investors easy access to the entire theme. You can buy ETFs just like you do any stock, and you get an instant investment in everything the fund holds, all the stocks or bonds in that group. For example, you can buy individual dividend stocks like Merck, ticker MRK, PepsiCo, ticker PEP, and Verizon Communications, ticker VZ, for their high dividend yields and the diversification. Or you can buy just one of my favorite dividend ETFs, the Schwab U.S. Dividend Equity Fund, ticker SCHD. The fund holds the 100 dividend stocks in the Dow Jones U.S. Dividend Index and produces a 3.2% yield along with solid price returns. Now, for that convenience of being able to invest automatically across everything in the fund, the ETF is going to deduct an expense ratio to pay its management. For a lot of these, especially in Vanguard and Fidelity and those Schwab funds, that expense ratio is almost nothing. Here, just a 0.06% expense ratio means a fee of just 60 cents for every $1,000 you have in the fund. And there are exchange-traded funds for just about every investing strategy, including dividend-paying stocks, real estate, and even bonds. It's a great way for beginner investors to put their money to work for them without having to worry about picking individual stocks. And there's actually a lot of investors that buy nothing but ETFs. I'll leave a link to a video with that strategy below in the description. Now, the last type of investment, before I reveal some of the most popular investing strategies, has a special place in my heart: real estate investment trusts. Real estate trusts, or REITs, are companies that own real estate and then sell shares just like other stocks. The company collects rent on their properties and then doesn't have to pay income taxes as long as it sends 90% of its income to investors through a dividend. That means you get a great way to invest in real estate without the tens of thousands or hundreds of thousands it costs to buy a property yourself, and you get a great dividend yield at the same time. Nation, I got my start as a real estate analyst so many years ago, and no other type of investment has produced as much family wealth as property. REIT stocks give you the opportunity to invest across a whole portfolio of real estate and the properties across the country. Since those REITs own the real property, the value is backed by those hard assets. That's going to help support the price of their shares, so not only do you get a great return with these real estate stocks, but holding them along with your other stocks means you're not going to lose as much money when the stock market crash. Okay, long video. Everybody stretch. Get up, because we're getting to the part of every investing video where people kind of start tuning out: how to research stocks. But nation, this could be the most important part of the video, actually. I know it's not easy as just getting your stock picks from an online list or getting them from some Yahoo in a bow tie, but you need to do your own research and analysis into the stocks you buy, because you never quite know what someone else's motive is for pitching a stock. Throughout 1999, after finishing his homework each day, Jonathan Lebed would troll investing forums online, making stock recommendations. The 15-year-old pitched stocks on Yahoo Finance under more than a dozen accounts. Most of the companies he recommended were those nano-cap penny stocks, companies with very low prices and trading volume. He'd use his fake accounts to target a stock, pitching it until the volume and the stock price surged. When he was finally caught, he had made over $285,000 in profits on these pump and dump schemes. Before I show you how to evaluate a stock, I want to share some of the resources I use to get stock market news and what to watch. These free resources are the ones I rely on to keep me up to date with the trends and the ideas that I need without all the hidden motives and the paid spokespeople here on YouTube or other financial media. First is the weekly report by FactSet, the Earnings Insight Report, which you can find here on Google with the search for FactSet Earnings Insight. The company surveys Wall Street analysts on earnings expectations and then follows on the earnings for each company in the S&P 500, give you that big picture breakdown of the market. There are some great charts here, all free, and giving you that kind of deep information that you're not going to get on most websites. My favorite here, the sector PE ratios, shows you how expensive stocks in each sector are compared to each other and their own long-term valuations to show you which sectors are cheaper right now and where to buy. Another free resource all you out there in the Bowtie Nation will recognize is the Sector Tracker on sectorspider.com, one of my favorite big picture ways to look at the market. Here you can see how stocks in each of the 11 sectors have done over different time periods, from one day all the way to the last 5 years. You can click on any of these sectors to see which stocks in each to give you that idea of the types of companies that are doing the best and where you might invest. Because remember, you don't necessarily have to pick the very best stock out of the 5,000 plus traded in the stock market. By finding those big picture trends and the themes like which sectors are doing best, you can narrow it down to maybe just a few hundred stocks from which to pick. Then even if you don't find the very best in the group, you're still going to do well because that larger trend of the rising sector is behind you. Another resource I use is the Data and Stock Screener from Morningstar. I pay for the premium access here, but there's a lot of free stuff here as well, like analysis, financial data, and this valuations tab that shows you the historical averages of price valuations on each stock to compare and see if it's cheap or expensive right now. On the other hand, one thing you want to avoid is all these stock picking articles, the ads, and the armchair stock experts that you're going to find on places like Yahoo Finance, YouTube, and online. Some of these are okay to get ideas, but the articles are so often written by someone with little or no real experience in stock analysis. Because, nation, unfortunately, the truth is that investing has become an entertainment industry, and it's no longer about making you money. The investing industry is now about turning all of this into gambling and keeping you coming back for those short-term stock ideas and using that to sell advertising. You just have to be careful with where you get your investing advice. But it turns out it's not just investors that can learn something from researching stocks. In fact, government spies might just be lurking around the stock market for what they can see. In 1954, an economist named Armin Alkian was able to figure out the secret fuel used in the newly developed hydrogen bomb. Working for the Rand Corporation, Alkian did this by studying the share prices for chemical suppliers in the stock market. He was able to identify lithium as the fusion fuel using only publicly available financial data. Of course, the study was deemed a threat to national security, immediately confiscated and destroyed. For those non-spies out there, though, I want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. You are ready. By now you know what you need to know about the stock market and how it works. Now it's time to get down to business and look for how to find stocks to buy, how to evaluate a stock. And here there are primarily two ways to pick stocks: by fundamental analysis, which we're going to look at now. And this is what most investors do, looking at the value of the stock based on its earnings, the future of the company, really trying to understand what makes that stock better than others. The other way to pick stocks is called technical analysis. This is where you're looking for those patterns in the stock price and the charts and trying to forecast what the price will do next. This is usually more of a shorter term way to invest because you're really only looking for how those patterns have affected the price over maybe a day or a week at the most. To get you started in that fundamental analysis, I'm going to show you 5 financial ratios that will help you pick better stocks and understand which is the better company when you're comparing stocks. I'll also link in the description below to more of those in-depth videos for picking stocks. First though, a little reality check. I've got to be honest with you here, folks. After all the research, the analysis, sometimes you never know what's going to make a stock surge higher. In fact, if you've ever gotten the tune from Baby Shark or Gagnam Style stuck in your head, you're going to be able to relate to one of the weirdest jumps in stock price history. When Korean rapper Psy created the song behind Gagnam Style phenomenon, his father was the chairman and controlling shareholder for a semiconductor company called Dai Corporation. As the song took over YouTube and the world, in fact, shares of Dai surged over 800%. I do want to show you those 5 stock market ratios though, because these are going to help you pick better stocks. It might not guarantee the jump in price immediately, but you're going to invest in the best long-term stocks that are going to grow your money. And our first here is easily the most popular, the price to earnings ratio. Okay, before I get into these, I know I'm going to lose about half of the people out there if I say this is math, so I'm not going to say it. Every one of these ratios, though, can be done with just a simple method, and usually, if you're looking at the term, it's going to tell you exactly what to do. For example, the price to earnings ratio is just what it says. It's the price of the stock to its earnings or profits of the company. So you take the share price divided by the earnings per share, and that's going to tell you how much investors are willing to pay for that stock. How many dollars for each dollar of profit. For example, we can see here that shares of Apple are at $148 each, and if I click on earnings here above the chart, we can see that earnings per share over the last year. I'll add these up, and we see that the company has made about $6.11 per share in earnings. So if we take the share price and divide that by the earnings per share, we see that Apple has a price to earnings of about 24 times. Now, investors are paying $24 for every dollar in profit that the company makes. Now, a lot of investors actually misunderstand the PE ratio, so this next part is going to be important. The price to earnings ratio actually gives us a measure of relative valuation, and that word relative is the important part here. A lot of investors think that the PE ratio tells you which stocks are good investments, which are cheap, and which are expensive. For example, if I was comparing shares of Tesla against Apple, I have to pay a price of 45 times every dollar in profits for Tesla stock. That's that price to earnings ratio. Whereas I can get those shares of Apple for just 24 times its earnings. And what happens is beginner investors might look at that and think automatically that makes Apple the better investment because the shares are cheaper on that PE ratio. I only have to pay a price of 24 times each dollar of profit versus the 45 times on the price to earnings for Tesla. But that's not really what the price to earnings ratio is going to tell us. Remember that word relative here. It means in comparison. Now the PE ratio tells us how stocks are valued compared to others or compared to the PE ratio of the entire market. But the problem here is that while shares of Apple might be cheaper compared to Tesla right now because that PE ratio is lower, it doesn't automatically make Apple a good investment. Maybe the PE ratio for both is expensive and neither is a good deal, or maybe the PE for both is cheap and both are still good investments. So one thing you always need to do when you're comparing stocks, especially when you're using this PE ratio, is you look back at the average PE ratio over the last few years on a stock. If I go here to Morningstar and I look at that PE ratio of Apple over the years, I see it's been as low as 11 times back in 2015 and averaged 24 times over the last 5 years. So just looking at this, even though the PE ratio for Apple is cheaper relative to Tesla, it's actually only about average given those recent years and expensive compared to the stock's history. Investors are willing to pay more for shares of Apple right now, so 24 times each dollar of profits, but have in the past only been willing to pay maybe 13 or 18 times its earnings. Now, it's a lot to throw at you right now, but just remember, when you're using the PE ratio to compare stocks, first, it only is going to tell you one stock is cheaper or more expensive compared to another, not necessarily which is a good investment. For that, you're also going to need to use some of these other analysis or the ratios together. But also, besides comparing the stock's PE ratio against another, you should also always compare a stock's current PE ratio with where it's been in the past, its own history, to see if it's relatively cheaper or more expensive than it has been. Now, one last thing to remember about the PE ratio is it's going to be very different for different companies. Like we saw for Tesla, investors are willing to pay $45 for every dollar of profit, but only willing to pay $24 for every dollar of profit in Apple. Why is there such a huge difference for what are arguably two very good companies? And the answer is growth. If we look at how fast Tesla is growing its profits, we can scroll down here and see in the most recent quarter, the company booked an increase of 56% in its earnings over the last year. Now compare that to what Apple can do, and we see that the company has only booked an increase of 8% in its earnings over the last year, which is still good, but not even close to that growth we see in Tesla earnings. So now this makes sense if you think about it. Wouldn't you pay more for a share of profits in a company that's growing those profits by 56% versus one that's only growing at an 8% annual rate? You bet your ass you would, but that kind of muddies the comparison, doesn't it? How do you compare the PE ratio between Tesla and Apple when the growth rate of the earnings is just so different? The answer is our next ratio, the price to earnings to growth ratio, or PEG ratio. Now this little change to the PE ratio is going to make it so you can compare those seemingly expensive growth stocks against the others to see which are really cheaper or more expensive. And the formula is exactly what it looks like here. You take that PE ratio and divide it by growth rate of earnings. For example, we had the PE ratio of 45 on shares of Tesla and an annual growth rate of 56%, or just 56. So 45 divided by 56 equals 0.8 times on that PEG ratio. On the other hand, shares of Apple were trading at 24 times price to earnings with a growth rate of 8%. So 24 divided by 8 equals 3.0. And so for all the number nerds like myself, what we find here doing this kind of comparison is really interesting. This tells us shares of Tesla are less expensive than shares of Apple when you account for that growth of each company. So that PEG ratio is just a great tool for adjusting your stock comparison for those super fast growth stocks that are some of the most popular in the market, really comparing them on an even playing field with some of the older companies. I've still got 3 more financial ratios to show you, but I bet you didn't know that buying a stock can actually save your life. Check out the video here in the corner for the 9 stocks to watch and how they could have prevented 9 of the weirdest ways people have met their end. From valuation measures to one that measures the effectiveness of management, how well management is able to grow those profits we have the ROE, or return on equity. Now, the ROE is the company's net income or earnings per share, those profits that you find at the bottom of the company's income statement, then divided by the amount of shareholders' equity found at the bottom of the balance sheet. So for this, we do have to dig into the company's reported financial statements, and you can find all these numbers either go into the Financials tab on Yahoo, or we can find the ROE directly in the Statistics tab. Shareholders' equity is the asset value of the company after deducting what's owed on debt, so the balance sheet value of what the company actually is owned by investors. So if you think about this, the return on equity is how much profits management is able to create using investors' money. How well does management take that shareholders' equity and create profits from it? And here, there's a few ways you can use that ROE to compare and find the best stocks. One is just by comparing the ROE of one company against another to see which has management better able to generate those profits. Another way, though, is to compare a company's current ROE against its own history to really see if management is becoming better or worse at squeezing out those profits. For something like this, 1 year to the next probably won't tell you much, but you want to look at a trend over several years. Now, obviously, you'd have to be worried if management was getting progressively worse at making profits, if that ROE was falling for years. My favorite way to use this, though, is you can compare a company's ROE against the average ROE in its industry or the sector. So for example, how well does Tesla management generate profits versus the other car makers? Or how well does Apple do that versus other consumer electronics companies? And we kind of alluded to this, but that's going to bring up a really important point that we need to talk about before moving on to our next market term. All of these ratios, they're going to be different across industries and sectors, especially the return on equity. And what I mean here is just because how different the market is for, say, electric vehicles versus consumer electronics, that's going to mean that it might not be as simple as comparing Tesla's ROE against that of Apple. For example, Apple has an ROE of 175%, which means management is able to get a return or a net income of 1.75 times the company's equity. Now compare that with Tesla, which has an ROE of just 32%, which is the company's income of $11.2 billion over $35 billion in equity. And again, we see that huge difference in the ratios of these two companies, but what you have to remember is that the industry for making electric vehicles, the operating costs, or revenue, everything is nothing like it is in consumer electronics. So comparing that ROE, the return on equity, straight across just isn't a fair comparison. Now, you can still compare the ROE across any two stocks, but you also need to compare each company's ROE against others in its industry, the industry average. For example, how well does management at Apple do in turning that equity into profits compared to similar consumer electronic companies like Garmin maybe? How well does Tesla management do in generating those profits compared to Ford or GM? Doing this across all these ratios is not only going to help you compare stocks against each other, but also help you pick the best company within each sector, what we call a best of breed. Now, all you out there in the Bowtie Nation, you're going to recognize this next ratio because it's arguably my favorite, the operating margin. And the operating margin is a measure of profitability. So how well does management turn those sales into profits? Now again, like most of these, you can calculate this yourself fairly easily. This is just by taking the company's total revenue found at the top of the income statement divided by operating profits or operating earnings a little further down. Or you can just use this calculated number that's given on the statistics page of Yahoo Finance. And I love the operating margin so much because it's just that core measure of profitability for any company. How well does management actually take its sales and turn that into profits after paying suppliers, paying everything basically to run the business? Are those costs like wages or marketing running away and eating up the company's profitability, or is management just becoming more efficient and turning in higher profits? So comparing this against other companies as well as the company's own trend in its profitability, it's a great way to find stocks to buy. From measures of profitability to a measure of risk with the debt to equity ratio. Now, over the last few years, just to stay alive during the pandemic, companies have borrowed trillions of dollars. So this one is going to be extremely important, so make sure you're not investing in companies that are now over their head in debt. Like most of these, the debt-equity ratio is just what it says, the company's long-term debt from the balance sheet divided by shareholders' equity. Here we see Apple owes $120 billion in liabilities, and shareholders own $50.6 billion in equity, for a debt-to-equity ratio of 2.37. What this tells us is Apple owes debt of 2.4 times the amount of shareholders own of the company. Debt is 2.4 times its equity. And again, like those other ratios, that really doesn't tell us much in isolation. We then have to compare that debt-to-equity ratio against similar companies and against the trend in Apple over the last few years. Doing this is going to tell us if Apple owes more relative to its competitors or even its own history. And why this is important, of course, is because that debt can get out of hand so quickly, especially if the economy stumbles. A company that owes too much might find it harder to make those interest payments if its sales fall. Because it has to prioritize repaying that debt, it might also have to limit how much it spends on marketing or develop new products or the other things that makes it more competitive. You know how to invest. Now click on the video to the right for the 9 stocks that could save your life. 9 stocks to buy in 2023 and why you won't want to wait. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.